Welcome to University Educational Platform for Equities, and today we're going to talk about stock market volatility. As always, we want to start with the reminder that we're going through this as educational information only, not to be construed as personal investment advice, as we are not financial advisors. Now, when you think about volatility, it's basically how much uncertainty or risk there is related to the value of a financial instrument. So people think of it as wiggle, as wildness in the stock itself. If you look at stock volatility, some stocks have high volatility, meaning they swing wildly up and down. Other stocks have very low volatility, meaning that they swing a lot lower on a normal basis. So, an example of high volatility might be something like Tesla stock, which swings wildly over time. Low volatility might be Walmart stock. Now, any stock could go through a period of high volatility compared to their norm, or low volatility compared to what is normal for them. Volatility in markets is not something that we necessarily need to be fearful of because, in fact, as traders, we embrace that volatility and it creates a lot of profit potential. But when you think about volatile markets and wild price swings, they're often a result of an imbalance in supply or demand, meaning the reason that an asset would shoot sharply higher would be that demand is coming in so aggressively and people don't want to sell, right? Some news, some item, some market event has caused that stock to run violently, wildly to the upside. Vice versa, sometimes you'll see market sell-offs or individual stock sell-offs where the selling pressure is so severe, people want out at any price that the stock will just completely fall in sharp fashion. And it's a supply-demand imbalance. So much selling pressure or so much buying pressure pushing on that stock that the price has to move to adjust to find that. So in the market, there are known events and unknown events. There are certain things that the market knows about ahead of time, and so it's not much of a surprise. Other news events that nobody could be prepared for, true black swan events that come out of nowhere. So let me give you an example of what we would call a known unknown. The known element might be scheduled. For example, there might be a Fed meeting and it's scheduled for February 5th at 2 o'clock p.m. Eastern Time. In other words, it's on everyone's calendar. Everyone knows it's coming about. But there is an unknown aspect to it. We don't know what the Fed's going to say. We don't know whether they're going to raise rates, leave rates unchanged, et cetera, et cetera. So there is a known event with an unknown element to it. Those tend to not get huge reactions because everyone's prepared ahead of time. That known portion, the fact that the economic event was scheduled, that everybody is already familiar and aware of that, it gets priced in, and so there's not typically a huge reaction. There are in the stock market what we call unknown unknowns, and those are true kind of black swans, meaning it's unknown, it's not on anybody's calendar, and then there's all the unknowns of what happens next. For example, a pandemic. When the pandemic hit, nobody planned for it for 2020. They weren't saying, well, for this year, we need to be prepared for a massive pandemic. No. And nobody knew exactly what the ramifications were going to be. How bad is this pandemic? What's the death rate? How widely spread is it? Will there be a vaccine? When will that vaccine? So there's First of all, it comes out of nowhere. It's not scheduled. And secondly, there's all the unknown elements, and those unknown unknowns create huge volatility events. Examples can be natural disasters, man-made events like terrorist activities, things like that are true unknown unknowns, and they tend to get huge reactions and big supply-demand imbalances that fuel that volatility and see outsized price moves. Hope you've enjoyed this class on stock market volatility. Have a great rest of your day.